Hi, listeners. Welcome to yet another podcast of Indianivesh. Generally, the period from January to March is spent in understanding taxes, to plan or save your taxes. Imagine if you have to go to multiple places to fetch information. That's why we at Indianivesh have simplified this process for you with a podcast on how to plan taxes. India has one of the highest tax liabilities in the world. This means that the large amount of income is taxed. What is tax planning? To plan taxes is to analyze your financial situation and to build a strategy from a tax perspective. However, there are ways to reduce your taxes if you plan efficiently. The Income Tax Act recognizes various tax saving instruments and avenues which can help reduce your tax outgo. So, why not plan to ensure that your hard earned money is not taxed, especially when there are ways to reduce it? Tax planning and management can be done easily if you know how. The tax experts at Indianivesh has put together these following points. The first is to understand your gross annual income from all sources. If you are employed, this would be your annual salary. If you are an entrepreneur, your business or professional income would be the major source. Also include other sources like income from house property, capital gains, income from other sources, etc. The second is to reduce your taxable income. If you are an employee, you can restructure your salary to optimize tax saving through the different types of tax planning. There are some components in your salary structure which can be used to lower your taxable income. They are house rent allowance, leave travel allowance, medical reimbursement, meal allowance, etc. Claiming these allowances will help you pay lesser tax. Dear listeners, as per the tax experts at Indianivesh, the third way to save taxes is to use tax saving investments. There are various tax saving investments under Section 80C of the Income Tax Act. Investing in these funds can avail a tax exemption of up to rupees 1.5 lakhs. Some of the funds are Public Provident Fund, Life Insurance, Equity Linked Savings Scheme, Fixed Deposits, National Savings Certificate. Also, you get an additional exemption of rupees 50,000 if you invest in the National Pension Scheme and also have a home loan. Furthermore, your saving account interest can be claimed as an exemption to up to rupees 10,000. So it would be good to explore all possible investment options and reduce your taxable income. The next way to save taxes is to take help from family members. Dear listeners of Indianivesh podcast, if you are living in a property owned by your parents, give them rent and claim the HRA. If you don't have an HRA component, you can still claim exemption on the rent paid under Section 80GG of the Income Tax Act. Investing in a tax-free instrument in your spouse's name can also earn you a tax-free income. Pay health insurance premiums for your family and parents. If all your family members are below the age of 60, you can earn a tax exemption of rupees 50,000. If your family is below 60 but your parents are above that age, the maximum tax exemption is rupees 55,000. If all of them are above 60, the tax exemption ceiling is rupees 60,000. Keep tax proofs handy for verification. The taxman can ask for the last 7 years' documents. At Indianivesh, we always suggest to file your taxes before the deadline. This will help you get a quick refund if your tax liability is below the tax you have already paid. Now, the smaller details are of great importance too, dear listeners. Like the school tuition fees of the first two children are eligible for tax deduction under Section 80C. A mandatory contribution towards your employee provident fund is also a part of Section 80C investments. Plan your taxes with reference to your goals and tax bracket. If you are in a higher tax bracket, choose investments which will give you maximum tax relief. For instance, if you are in the 30% tax bracket, investing in equity can help save tax if you plan to sell them within 12 months. This is because there is a flat 15% short-term capital gain on selling your equity within 12 months. This will lead to getting taxed 15% and not 30%. If you're benefiting from what you're listening to, then please do subscribe to Indianivesh's YouTube channel by clicking the bell icon. Here are some smart tips, dear listeners, when it comes to planning your taxes. First, opt for a monthly investment like an SIP in ELSS or a monthly contribution towards PPF. Avoid fixed multi-year or long-term commitments if your income is not stable. Complete your KYC with a fixed email ID and phone number for online transactions. E-verify your tax online using your Aadhaar number and bank account. Lastly, as we bring this podcast to an end, please note that taxes can eat into your annual income, so ensure you don't pay more than what's required. An effective tax plan will help maximize your wealth and save taxes. We at Indianivesh can assist you in this with our domain expertise. You can get the following advantages: tax planning and investment ideas, scientific and well researched process of product selection, suitable products that match your risk and investment profile. We hope you enjoyed and received some tax insights today. For more such content, stay tuned to our regular podcasts. Thank you.